Why is saving money the worst financial advice you could possibly get in 2026? I know that sounds crazy, maybe even irresponsible. We've all been told since we were kids, save your pennies. A penny saved is a penny earned. For generations, saving money was the bedrock of financial security. You put money in a savings account, it earned a little bit of interest, and over time, it grew. It was simple, safe, and it worked. But the world has changed, and the rules of money have changed with it. What worked for our parents and grandparents isn't just less effective today. It's actively making you poorer. Let's get one thing straight. I'm not saying you should spend every dollar you earn. Having an emergency fund, say 3 to 6 months of living expenses, is non-negotiable. That should be in a high-yield savings account, liquid and accessible for life's unexpected curve. But the idea of just piling up cash beyond that, letting it sit in a bank account for years, hoping it will magically turn into a comfortable retirement, that's a financial fairy tale. And in 2026, it's a fairy tale with a pretty grim ending. The number one enemy of your savings is a silent thief called inflation. Think about it. What could you buy with $10 10 years ago? A couple of movie tickets, maybe a decent lunch. What can $10 get you today? Probably just a fancy coffee. The $10 bill looks the same, but its purchasing power, what it can actually buy, has shrunk. That's inflation in action. Historically, inflation has averaged around 2 to 3% per year. That doesn't sound like much, but it adds up. Now, let's look at the interest rates on a typical savings account. Even the so-called high-yield accounts in recent years have struggled to keep up with, let alone beat, the rate of inflation. So, let's do some simple math. If your savings are earning 1% interest, but inflation is running at 3%, you are losing 2% of your money's value every single year, just by letting it sit there. You're not saving, you're actively losing purchasing power. Your money is on a treadmill, running backward. And that's assuming a normal economic environment. We've seen periods where inflation has spiked much higher. When that happens, your cash savings get absolutely decimated. The money you worked so hard to put away is melting like an ice cube on a hot summer day. It feels safe, because the number in your bank account isn't going down. But what that number can actually do for you in the real world is constantly decreasing. The second reason traditional saving is a failing strategy is something called opportunity cost. Every dollar you have sitting in a low-yield savings account is a dollar that is unworking for you. It's a lazy dollar. Think of your money as an employee. You wouldn't want an employee who just sits around doing nothing, would you? You want them out there, being productive, generating more income for your business. Your money should be doing the same for your financial future. While your savings are barely earning anything, other assets are growing. The stock market, over the long term, has historically delivered average annual returns far above the rate of inflation. Real estate values tend to appreciate over time. Even starting a small side business can generate income that dwarfs what you get from a savings account. By choosing to safely hoard cash, you are missing out on all of that potential growth. It's the financial equivalent of choosing to walk when you could be taking a high-speed train. Sure, walking is safe, but you'll never reach your destination on time. So, if saving is the wrong move, what's the right one? The answer, in one word, is investing. Now, I know the word investing can be scary for a lot of people. It brings up images of risky stock bets, complicated charts, and the potential to lose everything. But that's a misconception. Modern investing doesn't have to be complicated or high risk. The goal isn't to get rich quick. It's to get rich slowly and surely. The key is to shift your mindset from a saver to an investor. A saver thinks about hoarding cash and avoiding loss. An investor thinks about growing their assets and building wealth over time. An investor understands that their money needs to be put to work in a way that outpaces inflation. So, where should you start? The simplest and most effective way for most people to begin investing is through low-cost index funds or ETFs. Don't worry about picking individual stocks like Apple or Tesla. An index fund is like a basket that holds a tiny piece of hundreds or even thousands of different companies. For example, an S&P 500 index fund gives you ownership in the 500 largest companies in the US. By buying an index fund, you're not betting on one company to succeed. You're betting on the overall economy to grow over the long term, which, historically, has been a very good bet. It's diversified, it's low cost, and it requires very little active management. You can set up automatic monthly contributions and just let it grow. This strategy is called dollar cost averaging, and it takes the emotion out of investing. You buy whether the market is up or down, which averages out your purchase price over time. Another powerful avenue for investment is real estate. Now, this doesn't mean you have to go out and buy a $1 million apartment building. You could start by buying your own home instead of renting. Over time, you build equity as you pay down your mortgage and as the property value hopefully appreciates. For those who don't want the hassle of being a landlord, there are real estate investment trusts, which are basically like index funds for property. You can buy shares in REITs, just like you buy stocks, and you get exposure to the real estate market without having to fix a leaky toilet at 2 a.m. And let's not forget about the most important asset you can possibly invest in: yourself. This is something that gets overlooked all the time. Spending money on education, learning a new skill, getting a certification, or starting a small business can provide returns that are infinitely higher than any stock or bond. If you learn a skill that allows you to increase your income by $10,000 a year, that's a massive return on your investment of time and money. Your ability to earn is your greatest wealth building tool. Sharpen that tool. The world of 2026 is not the world of 1986. The old financial playbook is obsolete. The strategy of just saving your way to wealth is a guaranteed path to falling behind. Your money is losing value every single day it sits idle in a bank account. You need to make your money work for you. You need to become an investor. So, to recap, first, build that essential emergency fund. Keep it liquid and safe. But after that, stop hoarding cash. Shift your focus from saving to investing. Start small with low-cost index funds. Consider the long-term benefits of real estate. And most importantly, never stop investing in your own skills and your ability to earn more. But true financial safety in today's world doesn't come from hiding your money under a mattress or in a low-interest account. It comes from building a diverse portfolio of assets that grow over time and protect you from the wealth-destroying power of inflation. The worst financial advice in 2026 is to just save your money. The best advice is to put it to work. Your future self will thank you for it. Thanks so much for watching. If you found this helpful, please hit that like button and subscribe for more content that challenges old-school financial thinking. See you in the next one.